Big news from the Federal Reserve. The central bank has raised the interest rate 1/4 of a percentage point, moving it from 1/2 to 3/4 of a percentage point. And those projections also show that the group expects the Fed to raise rates 3 times in 2017. Officials concluded their 2-day meeting this afternoon. Chair Janet Yellen spoke shortly after their decision.
Over the past year, 2.25 million net new jobs have been created. Unemployment has fallen further, and inflation has moved closer to our longer-run goal of 2%. Economic growth has picked up since the middle of the year. Household spending continues to rise at a moderate pace, supported by income gains and by relatively high levels of consumer sentiment and wealth. Business investment, however, remains soft, despite some stabilization in the energy sector. Overall, we expect the economy will expand at a moderate pace over the next few years.
Rick Newman from Yahoo Finance joins me now to break it all down. Rick, good to see you.
Hey, Vlad.
So what factors did the Fed look at before making this decision?
Everything we've all been following for the last few weeks in financial markets. They pay a lot of attention to jobs and job growth, of course. They also care about wage growth. We've seen that improve a little bit. They care about consumers. Are they spending money? Do they seem to be in a better frame of mind? And all of those things have generally been going in the right direction. So the Fed finally, after a lot of hand-wringing, decided it's okay to raise interest rates by a grand total of 1/4 percentage point.
Janet Yellen also touting that 50 million new jobs have been created. The unemployment rate is at 4.6%, which is the lowest that it's been since 2007. But what does a rate hike like this mean for average American homeowners, for example, people with loans?
This is not going to mean very much for ordinary people. Again, these are short-term rates. This has a lot more to do with what goes on in the banking sector than the longer-term interest rates consumers pay on things like mortgages. Those are the longest-term rates, of course, usually 30 years. Car loans can be 5 years or so, 7 years maybe. And those rates probably won't be much affected by this. And the other thing is, you know, savers who live on fixed incomes, they've been waiting for some time for interest rates to go up so you can just earn a little bit more money on a bank account. That is probably not really going to happen because what we saw today does not translate directly into higher long-term rates. Now, as this goes on, assuming the Fed does what it says it's going to do and push these short-term rates up over the next few years to maybe 2.5% or 3%, that will eventually filter through to consumer rates. Right now, people just are not going to notice much of an effect.
Rick, this is the first decision the Federal Reserve has made since Donald Trump was elected. The president-elect has promised to cut taxes, loosen regulations once he takes office. So how will these rate hikes, even the ones that are planned for 2017, affect the president-elect's economic agenda?
Well, that's what everybody wants to know. And as we speak, reporters are asking Janet Yellen a lot of questions she's not answering about exactly this. And I think we have to point out that we know what Trump has said he wants to do. That doesn't mean it's done. We don't know how these things are going to happen. And the Fed, as it says over and over again until we all almost fall asleep, is data dependent, which means they look at things as they are in the real world to the best extent that they can measure them. They don't consider what an incoming president says he's likely to do. And in fact, we saw nothing in the actual statement that the Fed put out. They didn't even acknowledge there was an election. They didn't even refer to political uncertainty, which we've got a lot more of all of a sudden. However, once Trump takes office and they start to see what actually happens, that will become the data that they depend on to make their decisions.
And I want to get your take real quick, Rick, on this meeting that the president-elect is holding with these tech titans. What's your just brief hot take on that meeting?
Well, Silicon Valley doesn't like Donald Trump. There are almost no major CEOs who supported Donald Trump. Peter Thiel, of course, the billionaire investor, he's the one exception. He made a very risky bet by going public with his support for Trump over the summer, and that has paid off for him huge. So he's now sort of the liaison between the Silicon Valley CEOs who mostly favor Democrats and supported Hillary Clinton and Trump. So there are a couple issues that are really important here where there's a big gap. Silicon Valley cares a lot about immigration, especially their ability to tap well-educated, highly skilled immigrants who get these so-called H-1B visas and can do a lot of the engineering work they need done. Trump has said he doesn't like that program, and he'd even like to kill it. That's a big issue. for Silicon Valley. Another big issue that Trump favors that would actually benefit a lot of Silicon Valley firms is this idea to bring back corporate profits that are stashed overseas at a lower tax rate, just to get that money back in the country, doing something for the U.S. economy. That would be great for firms like Apple, Amazon, Microsoft. That benefits tech. That would benefit tech firms in particular because they happen to have a lot of money overseas. So that's one where you might hear the CEO saying, hey, we love that idea. We're all for it. And Trump might say in exchange, well, in exchange for that, I want you guys to meet me halfway on immigration. That's me imagining I'm in the room. Of course, we don't know exactly what they're talking about.
And Rick, I mean, the president-elect has said that he wants to bring manufacturing jobs back to the United States. He's talked about imposing penalties and tariffs on companies, American companies who do send jobs overseas. For example, Apple, we were talking about Apple. A lot of these iPhones and these MacBooks are made overseas. Could that affect them?
Yeah, and I would point out, Apple never made iPhones here in the United States, so those are not jobs that went overseas. Those are jobs that were placed overseas to start with, as one example. And I think a lot of companies are making that decision. Let's just start in China because they've got a manufacturing infrastructure we don't have here. But, you know, a lot of these tech CEOs, we saw the CEO of IBM this morning, G. Ramadi, wrote an op-ed, in which she said, you know, why don't we start with figuring out how to fill the 5 million or so jobs that companies say are open right now and they can't find workers to fill? And I think that's a great point. So if Trump is listening to these CEOs, they're going to be saying, you know, before you start kind of tearing up the system, why don't you look at the things that might be easier to do? These companies have all these jobs they can't fill because they can't find people with the right skills. Why don't we do something to fill the jobs that actually exist, instead of pretending that somehow we're going to bring back jobs from 20 or 30 years ago and relocate them from other countries back to the United States? That's extremely difficult to do, if it's even possible. So let's pick the low-hanging fruit here.
Rick Newman from Yahoo Finance with some really interesting analysis on the decision by the Fed to raise interest rates a quarter of a percentage point, and some interesting insights on the president-elect's economic plans going forward. Thank you, Rick.
Sure thing. See you.